Hello, and welcome back to Pratik Finance Facts, the channel that combs through financial news so you don't have to. Because let's be honest, who has the time for that besides us? And we do it for you, the viewer, because we care. Today, we're diving headfirst into a steaming vat of potential market chaos. That's right, we're talking about the Indian Budget 2024, and specifically, the top 5 ways Nirmala Sitharaman, the finance minister, may have just sucker-punched the stock market. Buckle up, because we're about to dissect financial jargon into something resembling a palatable, vaguely threatening smoothie. Now, I know what you're thinking, long-term capital gains tax. Just saying it out loud makes me want to reach for a double espresso and a spreadsheet, preferably one already filled out by someone significantly more financially adept than myself. But stick with me here because this is important, even if it does sound about as thrilling as watching paint dry on a slow Tuesday. This year, the Indian government has decided to tinker with the long-term capital gains tax, or LTCGT, as no one calls it, on debt mutual funds. Previously, these funds enjoyed a sweet tax advantage if held for over 3 years. But now, well, let's just say the party's over and everyone's scrambling for a taxi. This change means investments held for the long term will be taxed as ordinary income. Now, while that might sound boring, it's the kind of boring that could make your portfolio weep. We're talking potentially lower returns for investors, which could send a shiver down the spine of the stock market. Think of it like this. Imagine you're at a buffet, and you've been eyeing that delicious-looking plate of, I don't know, samosas. You've been patiently waiting your turn, but just as you reach for one, bam! The buffet attendant slaps on a hefty luxury tax because, well, samosas are now considered a high-end delicacy. You'd probably reconsider, right? That's kind of what's happening here. Investors might think twice about parking their rupees in debt mutual funds, potentially leading to a mass exodus and a whole lot of stock market jitters. It's enough to make you want to drown your sorrows in a plate of, oh, never mind. Startups. Those plucky, optimistic engines of innovation, fueled by caffeine and the unshakable belief that this time, this idea, this app that lets you swap faces with your dog in real time will be the one that makes them millions. Well, I hate to be the bearer of bad news, but the Indian government might have just thrown a pretty hefty wrench into the startup engine with what they're calling the angel tax. Now, this isn't some new tax specifically designed to punish those with feathered wings and harps. No, that would be too on the nose, even for a government. Instead, it's a tax on funding that startups receive from, well, anyone, really. See, when a startup gets a cash injection, the government wants to make sure that money is on the up and up, that it's not being funneled from some nefarious source. Which, fair enough. But the way they're going about it is about as subtle as a sledgehammer in a china shop. Essentially, if a startup receives funding at a valuation higher than what the government deems fair market value, boom, angel tax time. This means the startup has to pay a chunk of that investment money right back to the government as taxes. Ouch. This can be a real buzzkill for startups, especially those in the early stages who rely on these investments to get off the ground. It's like giving someone a brand new airplane, then immediately demanding they pay a surprise altitude tax before they're even allowed to leave the hangar. Not exactly conducive to soaring success, is it? And what happens when startups can't attract the funding they need? Well, they sputter, they stall, and sometimes they crash and burn. And that, my friends, can send ripples of uncertainty throughout the entire stock market. Chapter 3. All right, let's talk government spending because nothing gets the pulse racing like a deep dive into the intricacies of fiscal policy. Just kidding, I can practically hear you yawning through the screen. But bear with me because this is important. Even if it does sound about as exciting as watching a documentary about grass growing. See, the Indian government has hinted at some pretty significant spending cuts in Budget 2024. Now, on the surface, that might sound like a good thing. Fiscal responsibility, tightening the belt, all that jazz. And hey, sometimes it is necessary. But it's also a bit of a gamble. A delicate balancing act on the high wire of economic stability. When the government spends less, it can impact everything from infrastructure projects to social programs. Now, while some might argue that this can curb inflation, it can also potentially slow down economic growth. And a sluggish economy? Well, That's about as welcome as a skunk at a picnic when it comes to the stock market. Think of it like this. Imagine the economy as a giant engine. Government spending is like the fuel that keeps it chugging along. Reduce the fuel too drastically, and the engine might start to sputter. Sure, you might save some money on gas in the short term, but you also risk stalling out completely, which is not exactly a recipe for a smooth ride. So, while fiscal prudence is generally a good thing, too much of a good thing can sometimes backfire. And when it comes to the stock market, uncertainty is like a bad case of the hiccups, annoying, disruptive, and potentially a sign of something more serious lurking beneath the surface. Chapter 4. Let's talk tariffs, shall we? Those pesky little taxes on imported goods that governments love to slap on like unwanted bumper stickers. In the grand game of global trade, tariffs are like that one friend who always insists on playing Monopoly with the free parking jackpot rule. Annoying, disruptive, and likely to end in tears. Now, India has never been shy about throwing up a few tariff walls to protect its domestic industries. But Budget 2024 seems to be taking things up a notch, hinting at potentially higher tariffs on a whole range of imported goods. Now, on the one hand, this could be seen as a way to boost domestic production. After all, if imported goods become more expensive, people might be more inclined to buy local. But hold on a minute, because it's not always that simple. See, tariffs can also lead to retaliation from other countries. It's like a trade war, only instead of tanks and missiles, they're using import duties and trade barriers. And when countries start throwing up tariff walls, it can disrupt global supply chains, increase prices for consumers, and generally create a whole lot of economic uncertainty. Imagine you're building a house, and suddenly the price of imported lumber skyrockets because of, you guessed it, tariffs. You might have to put your construction project on hold, right? Now, multiply that by thousands of businesses across the country, and you can start to see how tariffs can throw a wrench into the gears of the economy. And a shaky economy? Well, that's about as welcome as a swarm of locusts at a farmer's market when it comes to the stock market. Investors get nervous, they start selling, and before you know it, you've got yourself a full-blown market dip. Chapter 5. Regulations. Those necessary evils that keep businesses in check and prevent the world from descending into a chaotic free-for-all. But sometimes, just sometimes, regulations can feel a bit like trying to navigate a bureaucratic maze blindfolded with one hand tied behind your back while riding a unicycle. And wouldn't you know it, Budget 2024 seems to be hinting at a whole new wave of regulations, particularly in sectors like finance and tech. Now, on the surface, this might seem like a good thing. After all, who doesn't love a bit of financial stability and responsible tech innovation? But here's the thing. Too much regulation, or even just the threat of it, can stifle innovation and make investors skittish. It's like trying to play a game of basketball with a weighted vest on. Sure, it might make you stronger in the long run, but it's also going to slow you down and make it a lot harder to hit those three-pointers. See, businesses crave certainty. They need to know the rules of the game so they can plan for the future. But when the regulatory landscape is constantly shifting, it creates uncertainty, and uncertainty is like kryptonite to investors. Imagine you're a farmer and you're about to plant your crops. But just as you're about to start sowing, the government announces a whole new set of regulations on fertilizer use. You don't know what those regulations are yet, but you know they're coming. Do you plant your crops as planned, or do you hold off and wait for more information? That's the kind of dilemma businesses are facing right now. And when businesses are hesitant to invest and grow, it can send a ripple effect through the entire economy, eventually making its way to the shores of the stock market. Outro, so there you have it. The top 5 ways Budget 2024 might have just thrown the Indian stock market a curveball. Now, whether these changes will lead to a minor market dip or a full-blown crash remains to be seen. The economy is a fickle beast, and predicting its every move is about as reliable as a weather forecast in a hurricane. But one thing's for sure, things are about to get interesting. So, buckle up, keep a close eye on your portfolios, and maybe stock up on some antacids, because the post-budget market roller coaster is officially leaving the station. And as always, thanks for joining us on Pratik Finance Facts, where we make the confusing world of finance as entertaining as watching paint dry. Just kidding. Mostly.